My backtesting is the backbone of my trading. I've tested over 100 strategies, I have 10 live automated strategies, and I've generated over 6 figures in profits. Here's how it all works in 60 seconds. I'm Manir, also known as Ghostlock Trades on Twitter, and I also run Unbiased Trading, an agency where we can backtest and automate your trading. Now, number one is clean data is everything. Bad data equals bad backtests. Ensure survivorship bias is removed by including delisted stocks. Don't just rely on free aggregated data providers. Find some solid providers such as the ones I use, which is Polygon, FMP, which is Financial Modeling Prop, and Kinetic. Now, why is bad data equaling a bad backtest? Well, overall, as a machine learning, if you put garbage in, so garbage kind of data, and you're expecting an amazing result out of it, it's not going to work like that. Anything you put into the system is going to have a kind of a correlation to what is the output, meaning that if you put really bad data in, you're going to get really bad results out. So if you're going to be backtesting over inaccurate data, whether that be maybe you manually tracked it, or it's going to be bad data in the sense that you're using some free aggregated data provider, unless like, if you're working on daily timeframes, you could probably get away with like Yahoo Finance. I think they're actually not too bad on a daily time frame, at least for if you're getting started. But anything intraday, anything like that, that sort of data, you want quality data. So normally for what I'm using is Polygon. You can find them online. They're pretty affordable and give you a good amount of data you can backtest over. FMP is great for fundamental sort of data, so earnings, market cap, float, that sort of stuff. And then there's Kinetic, which I use for futures data through NinjaTrader. Now, do keep in mind, all of these providers are still going to have errors. There's still going to be some discrepancies, but the amount of them is going to be a lot less compared to your manually tracked data, for example. Now, number two is factor in all costs. Include everything, whether that be commissions, spread, slippage, locates. Without accurate costs, any backtest will look amazing. And I have a graph here just showing how when you have no slippage, you're obviously going to have the best performing equity curve. And then once you even add like one tick or 1 or 2 ticks of slippage, where in the case of futures, you can already see performance drop significantly. So if you don't have an accurate sense of what your commissions, your slippage is going to be on a strategy, you need to be either taking track manually to see what could be a realistic estimate, or you can look up some estimations online on what other people use to get a general idea of what sort of slippage you should be applying to a strategy. Now, I will say there is a caveat here. You need to keep this proportional to how much time and energy you're actually going to put into this backtest. For an example, if you're only trading a $1,000 account, you don't need to be factoring in, massive slippage, massive market impact. If you're going to be trading something that's quite liquid, so if you're going to be trading, for example, Tesla, there's no reason you need to put in market impact and slippage if you're going to be trading a $1,000 account. Realistically, you're not going to suffer that much. Maybe if you're trading pre-market, but realistically, if you're doing anything intraday on those sort of liquid stocks, you don't need to be worried. I think ones that you'll never be able to get away from are any fixed costs. So this could be, for example, commissions, and secondly, could be locates. If you're going to be shorting small caps, you would probably want to factor in some sort of locate cost, whether that be a percentage of your total profits if you want to go really basic, or if you want to do something more complex, you could keep track of what general average locate costs are per day, and you could factor that into your model. Now, number three is proper validation is key. You want to split your data. So you have in-sample data, which is primarily just for development and optimization, and you have out-of-sample data, which is for testing. So whatever parameter values are most profitable, for example, on the in-sample data, you'll then want to test those on out-of-sample data. Now, there's different ways of going about this. You could do walk forward optimization. You could just do a general in-sample and out-of-sample test. But generally what this is used for is that you want to see if your strategy can hold up on unseen data. So this is going to be equivalent almost to live data. When you're taking a strategy, and let's say you had 5 years of historical data and you optimize over the whole 5 years, when you deploy that on a live market, technically that's what's kind of happening. You're testing on out-of-sample data that's coming in because it's never seen that data before and you have no idea how it's going to really perform on that data. So what you want to be doing is in your backtest, you want to be testing on out-of-sample data as well to get an idea of how well does the strategy actually perform on unseen data. We ideally want to see strategies maintain performance on unseen data. Now, there is one thing to actually note here. Most of the time, whatever you run on unseen data or out-of-sample data is always going to be lower performance than in-sample. I would say it's kind of weird if it's actually higher performing on out of sample. There could be potentially a leak there that you maybe leaked some data over into in sample and out of sample. However, you're always going to see it, for the most part, be lower performance on out of sample. That's totally fine. You just need to have some sort of threshold where, let's say it drops 50%, then that's maybe a bit worrying. But if it's 10%, 5% lower than in sample, I would say that's completely fine for the most part. Now, 4 is sample size is crucial. You want to test across multiple market cycles. You want to use different volatility regimes. You want to use various market conditions. The more data equals the more confidence. And I'm just going to let Jerry Parker in this interview take this away because I think he crushes it.
More rules leads to less sample size, so less confidence you can even have in your win-loss ratio on a back test. Is you want to have the largest sample size of trades as possible, and by over-parameterizing, you might be reducing that sample size, so therefore those returns are fairly spurious.
Nothing more important than that. You said it perfectly. Yeah, there's nothing more important than that. I know Neil's on his podcast, he used to ask people when he interviewed people, individual traders, what is the one question that people should ask you about their trading and their system? And in my opinion, that one question is, what's your sample size and how do you count it? And no one ever asked that question. But no, that's the most important thing. And in order to get a large sample size, you have to have a one entry, one exit, and a stop loss. It's not going to get too much better than that. I'm not saying that's the only thing you can use. Like, I think that reducing your positions and reducing your leverage during periods of crisis and to preserve your capital, that's a great rule. It sounds pretty discretionary, but maybe you can come up with a rule for it. And I think you should. In order to, when all hell starts breaking loose like last February, you need a rule. Let's reduce our risk.
Now 5 is run robustness tests. Similar to the outer sample test we mentioned earlier, that could also be classified in a robustness test, but you never want to skip these checks. You want to be running parameter sensitivity, Monte Carlo simulations, walk forward testing, and even doing stress periods. One good backtest is not enough. And I think this is where most people get the floor around backtesting. A lot of people are introduced to it by seeing, some sort of trader go over a manual chart and plot out their entry and exit. That's not really backtesting. A lot of that is recency bias. A lot of that can come down to human error and human bias. What a proper backtest is you want to be running multiple things. You have multiple tests that are checking for different things or checking for confluence between those things, for example. So, for example, for parameter sensitivity, what we're looking for there is, are we seeing huge spikes in performance with the parameter being changed? So let's say, the example I always give, let's say you're testing a MA period, so a moving average crossover, and you have it from 1 to 20. If we see every jump, very sporadic jumps between the MA period length and the performance, that's most likely not very robust. But if we saw that, hey, it actually has an optimum at around 20 and then it smooth kind of declines from there, that looks a bit more robust, because what we're saying there is it's more likely to have some leniency if you test that on live markets, that it could actually still perform, because it doesn't seem like it's just fitted to noise. Now, Monte Carlo simulations, I already actually have a full video on this on the channel, so if you want to learn more about that, feel free to visit that. And then walk forward testing is what I mentioned earlier, where we're doing, instead of just in sample and out of sample, we're doing a rolling basis period, meaning that we're testing in sample for 20 days, testing that on out of sample for 20 days, and then repeating and repeating. Stress periods is I basically taking a strategy and seeing if it can survive previous stressful periods for most strategies. So that would be 2020, 2008, etc. And you want to see how badly does it perform there. Now, you're not coming into the expectation to see if your strategy does 100% return on that day or something crazy. What you're trying to see there is, does it have a huge risk of ruin on those sort of days, and how could you potentially change it to reduce that risk on those stressful periods. And then 6 is reality check everything. Consider your position sizing limits, your market impact, your realistic fills. The market is unfortunately never as clean as your backtest. Now, this will probably be one of the most daunting things, I think, to people that get into backtesting, is that if you don't factor in all these sort of things, it can feel like you're not creating a realistic backtest. But I will say, for most people, unless you're trading, huge size, this is not going to be very relevant. It is something to always pay attention to. And also, one thing I will say is very important is a lot of traders like to do a backtest and they'll put on compounding size, and they'll never take into account these sort of changes that will come up when you're introducing that much size. I often see a classic is someone will say, hey, they backtested and their $5,000 account turned into 2 million, right? But that's all because of compounding size, and they don't understand that maybe at 100K, their slippage on that particular strategy is going to go through the roof, and that will crush the strategy at that particular size. So that's why always when I do my trading recaps, which is where I just go over my performance over the month, I say that, this is limited to my size currently. I don't think this is going to, if I deployed $1 billion of capital, I don't think these returns would remain the same. They would degrade 100%. But I will say, luckily for us, most of us are not trading, $1 million, $1 billion accounts. So we don't have to be too worried about this, but it is something to pay attention to if you are going to be trying to do compounding sort of strategies.
But then it gets to be a pretty low risk adjusted return to do the last half. Literally, since our Goldman Sachs days, this is more than 25 years ago, we've generally used half a backtest out of sample as a bogey. And life has worked out fairly close to that. Now we've built more factors, improved our backtest, so it's not necessarily half of what it used to be, but that's not been far off, and we would consider that a victory. If you have a decent backtest that you don't think is over data mined, that you think is reasonable, that you understand the economic spirit, that you've tested robustly in a whole bunch of places, all of that, still assume half going forward. And half is obviously a rule of thumb. You may sometimes think 2/3, 1/3 makes more sense, but it's good to have a simple thing you don't deviate from.
And if you want to unlock the full skill of backtesting in 2025, I've opened up the Backtest Bootcamp. It saves you hundreds of hours with proven code templates that will allow you to see how to backtest particular strategies, and then you can learn how to modify them from there. You'll also learn how to build robust, profitable strategies from complete zero. You don't need any previous knowledge. And you'll also be able to build unshakable confidence through data. Backtesting by far has been one of the biggest things that has helped me improve my trading. It's made me objective, it's helped make me profitable, and I could just go on list and list of how well backtesting has really helped me model and be very objective around trading. I no longer really use any intuition or gut feelings, and I can model out my sort of decisions and see if they'd actually be beneficial for my particular portfolio of trading systems. If you are interested, I'll leave a link in the top of the description, but no worries if not, I'm always going to be providing free content as well. But if you want to kind of speed up your learning process and gain the skill of backtesting and become more systematic in your trading, then feel free to visit and see if it's something for you. Now, if you find this type of content valuable and want more every single week, feel free to follow me on Twitter. Otherwise, subscribe, and I hope you had a great day.